Stop believing what they're telling you. The banks are still in crisis mode. I'm going to show you the evidence of that today. I'm going to show you how extreme it is and the fact that they're not even trying to fix the problem. They are simply ignoring it. All of that in today's video and more. Let's begin. First things first, we're going to look at what's going on with the US dollar. You have seen the absolute strength over the last while, and then more recently, the US dollar has weakened against other currencies. This was the biggest single day dollar slide in 3 weeks. Dollar's drop erases almost all of the week's gains. The dollar fell on Friday, pairing almost all of the week's gains after slowing U.S. jobs growth in July encouraged hopes of a soft economic landing, but higher wages suggest that the Fed is going to have to keep interest rates higher for longer. The battle rages on. Are they going to increase more? Are they going to stop? Are they going to cut? We all will only see in time. But I've told you something in a previous video a couple days ago that is something you can't ignore. And that is, if the idea from the US government is to create more debt, if they're going to try to spend more money, there has to be a buyer for that debt. So the yields will rise. And that means they've got to borrow more. Constant borrowing costs rising, that is a trouble, very big trouble for them. Who is the buyer of last resort then? Well, of course, it's the Federal Reserve. The Federal Reserve is going to have to be there. That means they're going to have to do an operation. It doesn't have to be QE in name, just like we saw from September 17th, 2019, all the way into when they started the official QE in 2020. The balance sheet expanded at a faster rate than QE 1, 2, and 3, all while never calling it quantitative easing. You can call it what you want. That's the expectation that is front and center today. The banks, though, they are still dealing with a crisis right now. I'm going to show you some elements of this today. I've got a lot of charts, in fact, to show you. Wanted to give you this one first. Money markets. More people are putting money into the money market funds. Why? Well, I think you know already. If you're going to get 5% on your money in a money market fund, you could pull that out tomorrow and you'd be able to get that. It's super liquid and so on. So, of course, it's very attractive. People, instead of putting the money in cash, as I'll show you in a second here, this is what they're doing. Are you, the individual out there, are you doing the same thing? Do you have your money in a bank account? Do you have it in money market funds? I'm talking about, so your liquid cash. What are you doing with your money? You've got to be aware of that. If you don't feel comfortable putting in the comments below, then please let me know, okay? Through Discord, through wherever you got to do that. I want to know what you're up to. I want to be able to make sure that you're making the right choices. This is the discrepancy, as you can see. Money market funds, that's the green line, compared with deposits, and that has been overall declining for several months since there's been that concern. You have seen that going down and down and down. People don't want to put their money in the bank for obvious reasons, right? They don't feel comfortable with it, that's for sure. The banks are not doing well. That's clear. But at the same time, they're not going to get any return from it. Why are you going to put it in the bank if it's going to get much less return? You got to look at what's going on with liquidity. I have talked about this over and over again. The number one thing to be able to determine what's going to happen in the markets is liquidity. And so the number one factor for liquidity is what the Federal Reserve is doing, and that is with their quantitative easing, or right now quantitative tightening. So they've been selling off their treasuries and their mortgage-backed securities. This is drying up the amount of liquidity. Other buyers could come in, buy that all up, but it's always a balancing act. And the Federal Reserve is trying to control this. They are doing at any given moment like $2 trillion in reverse repos to try to balance this out. It's like a seesaw, right? You're going back and forth, back and forth. But if one person is an adult and the other one is a kid, you're going to have a very uneven, non-balanced system, and that's going to create a problem. Right now, they're trying to make that happen, but you have a balance sheet that was $9 trillion. You're coming down, and that's got a long way to go to get back to what they would call normal. So you could see this, and this. This is the big one, my friends. Check it out. You're seeing what probably looks like nonsense on the screen if you can't read that, but essentially this is the Bank Term Funding Program, BTFP. This was set up specifically for these banks. March came around, banks start failing, SVB, all the others, and then we had the Federal Reserve step in, and we want to set up a special emergency fund so you can come in and you can get this. All right? We're going to do that. It's an emergency. Then they started getting more usage and more usage and more usage and more usage. And here we are today in August, and it is at a record high. Do you see what's going on? That the banks are still dealing with this issue. They haven't stepped back from it. They haven't been, let's just say free from all of it. It's still a problem today. Why? Because interest rates are high. They were so low for so long. They were told it was going to be transitory. And here we have it. The evidence is right in front of our face that this is a facility which is, they're basically borrowing at a higher rate than they would. They're using other means, but they're using it anyway. This is, in fact, still an ongoing crisis. I don't know how far it's going to go. I don't know how bad it's going to get. But at this time, nothing has been stopped. Nothing has been stopped. And that is a simple matter of fact. You've got to get wise to what's going on. Take a look. You could see the green line, which is the U.S. stock market. Okay. So you've been noticing that it's been going higher. Obviously, Amazon, one of the biggest companies in the world, goes up by 11% at just instantly. That's very unusual. For one of the biggest companies in the world, it's not a penny stock to go up 11%. But these are the things that happen, right? We go to extreme scenarios. Comparing that with, this just says, U.S. reserve balances with Federal Reserve banks. Okay, so the commercial banks keep their balances over there at the Fed, and that generally, very much so over the last few years, has tracked what happens with the stock market to a great degree. And yet, we see a major divergence that has been taking place. And so that is an indication that we've gone ahead of ourselves. Doesn't mean the stock market can't go up. It doesn't mean that reserves can't come up with it. It just means that at this moment right here, we have diverged considerably. That's why I say to people, just be mindful of where your money is going right now. You've got to watch out. That's all. I'm just trying to tell you that. I'm trying to explain this to you. Do you have your retirement account in check? Do you have your, what I would call the risk part of your portfolio in check? Watch out right now. That's all I'm saying. In addition to that, we have this, which is NASDAQ streaks of overbought readings from 1971 to right now. And it is the highest it's been, the longest of overbought that we have been going all the way back into the late 90s. And of course, dot-com bubble, right? So you'll see that, and just to be clear, this is when consecutive days where the NASDAQ traded one or more standard deviations above its 50-day moving average. So it's a good way, because when you look at this, it's a moving average, not based on like, hey, we're not in 1990s anymore, things have changed. It's all based on moving averages. So in this respect, we have gone overboard. And when you look at it compared to liquidity, what I showed you was the second most important factor for liquidity. So we've got the QE, the QT, that's happening right now. Secondarily, we're looking at the reserve balances at the Fed. That's number two. But when you measure it using like this technical analysis type indicator, we're also overbought considerably. So I would be very careful if I'm going to go and take major risks right now. You want to sort of maybe trim some winnings. I'm not saying sell all your portfolio. I'm not saying that at all, but maybe now's the time to look for something that is a little bit more depressed in price. Okay. Part of that, I wanted to just be very clear. Like, why are these banks using the BTFP? Why would they do that? Why are they using this if the interest rates are not necessarily the most attractive? What it says here is the ability to borrow against collateral at face value rather than at the market value as under the discount window. So they have different options. One of them is called discount window. And it's just saying that this was seen as the new program's strongest selling point. And that's what the banks were up to. Okay. So maybe because they had purchased a lot of their assets at very low prices, maybe now things have changed. So using this is sort of beneficial to them based on their circumstances. So all I'm trying to say is not just one-sided, but all I wanted to highlight was they are borrowing from something. They are using this lifeline more than they ever have before. This is a concern. You can't get around that. You can't spin that. That is a simple matter of fact. And when we look at these, cause for concern, I think that people should just be aware and look at what's happening in the markets. Things are getting real crazy. So just take that into account when you make, when you're putting those dollars, your hard-earned dollars down somewhere. I'm going to cover really quickly, global level, looking at what's going on with other central banks. Japan's fiscal plight draws scrutiny after the BOJ tweak to the yield. When I see this, I really, to me, this is just shocking. But anyway, so what Japan has been doing is they've been doing every possible method of trying to, manipulate their interest rates and all of this. And I believe that this has become a big problem for them. Okay. They have really failed in this respect. Yield curve control doesn't fix anything. But anyway, they're going to go ahead with it regardless. The currency, I don't believe is going to be as strong as it once was. You can see that it hasn't really picked up strength. And so people are going to lose out. People holding that currency are going to lose out. Venezuela's bolivar weakens against the US dollar, obviously. And Cuba bans company access to ATMs, limits cash transactions. Capital controls don't work. These things are terrible to see because people are getting hurt. They're getting hurt. No matter where you look at it, it is a struggle for individuals trying to deal with inflation. You're looking at the banks dealing with it in their own way. What I say to you is watch where you're putting your money right now. Take a look at the data. Look at liquidity. That's my message for you. Right behind me, that's the money mirror method. We just had, just prior to this recording here, we had the mentorship group looking at this money mirror method in depth. And I think it's really important for people to understand liquidity. That's all. If you measure liquidity, you're able to determine what happens in the markets. That's why I was able to pinpoint what happened in October when the market came up from there, because I could look at these things, look at a few basic indications, technical analysis indications to further solidify that and say, yeah, it looks like probably at least a near-term bottom. And here we are. So that's what we get. If you want to know about this kind of stuff, the money mirror method, if you want to be able to pinpoint certain things, you want to know about self-sufficiency, like all kinds of different stuff and way more coming. Why don't you join the Discord? It's totally free. Link is down below. Almost 1,000 people. We're getting 20, 30 people every single day joining up. Totally free and lots of free info for you. Click that link in the description and say hi when you come in and I'll be there. Take care.